How liquid are box spreads and why does it matter? Have you ever wondered how liquid box spreads are and why that matters in options trading? Let's break it down together. A box spread is a unique options trading strategy that combines a bull call spread with a bear put spread. All four options share the same expiration date but have different strike prices. This setup aims for a riskless payoff equal to the difference between the strike prices at expiration, assuming no early exercise or dividends come into play. Now, when we talk about liquidity in box spreads, it's important to note that they tend to be less liquid than simpler options strategies or single options contracts. Why is that? First, executing a box spread involves for separate option legs. This complexity can increase transaction costs and make it harder to find willing buyers or sellers. Additionally, market makers and traders usually focus on more common spreads or outright options. As a result, the volume and open interest specifically for box spreads are often lower. Most box spreads are constructed using European-style options, which are less common in certain markets compared to American-style options. This difference further reduces the number of participants willing to trade these spreads. Because box spreads are frequently used for arbitrage or interest rate-related strategies, they attract a narrower group of traders. This means that the bid-ask spreads for box spreads can be wider. When liquidity is low, finding counterparties to open or close these positions quickly can become a challenge. This lower liquidity can lead to higher implicit costs beyond just commissions. So, why does liquidity matter? It affects several key areas. First, execution costs can increase with lower liquidity. Wider bid-ask spreads mean it costs more to establish or close a position. Second, the speed of execution can slow down. If a box spread is illiquid, it may not be filled immediately at your desired price, which can expose you to slippage or partial fills. Moreover, risk management becomes critical. Box spreads are designed to be riskless or nearly riskless. However, if you struggle to close a position promptly, you could unintentionally introduce risk. Lastly, profitability is impacted. Box spreads relying on capturing small arbitrage profits or the difference between the net premium paid and the strike price difference. High transaction costs from low liquidity can eat into or completely eliminate those profits. For traders using box spreads as a hedging or arbitrage tool, these liquidity constraints mean they must carefully evaluate whether the potential arbitrage profit outweighs the costs and risks of trading in illiquid markets. They often prefer highly liquid underlying stocks and options that have substantial volume and open interest. Many traders use box spreads primarily in institutional or professional settings where execution can be managed more effectively. In summary, while box spreads offer a theoretically riskless payoff and can be useful for hedging or arbitrage, their relative illiquidity compared to simpler options strategies is a key factor to consider. This impacts transaction costs, execution quality, and the overall effectiveness of the strategy in stock trading and options markets.